You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views. We are indeed the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from this here Options Insider Radio Network, ever expanding, ever exciting. Let me just mention to you at the top of the show here, if you haven't done so already, run, don't walk to your app store, the Google Play App Store, the iTunes App Store, even the Amazon Kindle Fire App Store, and check out the Options Insider Radio Network mobile app. You can, of course, stream all of your favorite episodes of Vol Views instantly right there from the app. You can also download them. Let's say you want to go on the subway or on a plane or somewhere else where you don't have that much signal, that much internet access. You can store them all there for offline listening at your leisure. You can even use the feedback suite there in the app to get a hold of us here on the program. A lot of great features. Check it out again, the Options Insider Radio Network app in the iTunes App Store, the Google Play App Store, or the Amazon Kindle Fire App Store. I think you're going to like it. All right, and we have a bit of a truncated panel here on the old Vol View show today. Such is the way with volatility. You never know how things are going to swing. And today is indeed one of those days. A lot of people are traveling. A lot of people are running around. A lot of big conferences coming up in the industry. A lot of people are running off and traveling too. So we're going to have a bit of a truncated panel on the old Vol View show today, but we'll probably be joined a little bit later by good old Mark Sebastian once he gets back to the Option Pit HQ. But for now, we're going to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Vol Review. This is, of course, the portion of the show when we look back on the week that was from a volatility trading perspective. And as we kick off the old Volatility Review, I am joined by my cohort, my partner in crime, none other than Mr. Mark Sebastian from Swan Wealth Advisors and the Option Pit, holding down two jobs over there. Mr. Sebastian, welcome back to the program, sir.
Always great to be here. You know, I look forward to this time every week. It's my Zen time.
It is a cherished moment for both of us. All right, and it was another interesting week from a vol perspective. We are, of course, recording this today, listeners, on Friday, March 7th, to give you some idea of the frame of reference that we're talking about here. And as we're recording this, the old VIX cash hovering right around the 14 handle, down a little bit on the day, but pretty much unched on the day. But that was not the case throughout the week. We actually saw A nice pop earlier there in the week, given all the furor over the boots on the ground out there in Crimea and the unrest in the Ukraine and everything else, really lending a nice boost, a nice kickoff to the week from a vol perspective. Now, Mark, cover your ears because I'm going to say something I know is going to really bug you. And I'm going to quote a VIX move in a percent. And I'm just going to do it because it's fun and I know it bothers you. Of course, with earlier in the week, we had Ukraine tensions really flaring up. We saw VIX cash gapping up. I'm going to say it, Mark. I'm going to say 14%.
How dare you?
Tell me how deeply that bothers you.
How dare you?
Have you surrendered that battle? Because it's just it's so everywhere now, VIX, and everyone quotes it in percent.
It's the stupidest thing.
I agree, but you're totally swimming upstream on that one.
They can take our percentages, but they cannot take our freedom!
We saw VIX cash gapping up, not surprisingly, given all that was going on out there in the Ukraine and in that region. We saw VIX cash gapping up nearly 2 handles to about 16 or so. And then kind of the rest of the week was, I guess you can call it a trailing off period, as that initial shock and awe kind of came off a little bit. Volatility kind of came in gradually throughout the week as people started to realize maybe this isn't the worst of all things to possibly happen, at least perhaps not as bad as they initially anticipated. So the market taking a little bit of a step back. And again, as we record today, we're back to the 14 handle in the VIX cash. So kind of much ado about nothing from a open to close perspective on the week.
Yeah, it was interesting. For how much the market moved around, you would have thought there would have been more to discuss, or you would have thought the VIX would have either been way higher or way lower, and it just simply wasn't. It was a really odd week where, I would have thought the VIX was would have ended up at 12 or at 18 and ended up doing absolutely nothing the entire time. Pretty impressive, actually.
Yeah, it seemed like it should have been destined for some extreme end of the range, and instead we're going out, if all stays as it is right now, we're going out this week essentially almost unched from a vol perspective. So that's kind of an interesting development in and of itself. There was some interesting trading lighting up the old tape out there in VIX land this week. We saw some interesting stuff. Today, actually, is still a big volume day for VIX, even though not a heck of a lot going on in the broad markets, in the broad indices. Most of the major indices kind of unched. The Qs actually having a bit of a sell-off today, so they're moving a bit more than the rest. But other than that, not a heck of a lot going on in the broad markets. Yet today, if you look at all the rundowns of top options volume, VIX is leading the charts across the board in terms of strikes and in terms of index in particular. The biggest trade of the day actually still is a big block of April 18 calls. Went up this morning 16,000 times in one big block. Looks like it was a sale for about $1.05. As we dig into the rest of the volume so far today, a total of 23,000 have gone up on this strike so far. But of course, people always ask us and write in and say, hey, why don't you do more, unusual activity on the VIX and things like that. And the problem with VIX is it's just become such a popular product these days. There is so much noise, particularly in some of these near-term months here and near-term expiration cycles, that it's hard to really separate the wheat from the chaff. That is, in and of itself, a very interesting trade. We don't highlight a lot of upside rights very often in VIX, so that alone is interesting. Of course, there's 125,000 contracts open on this strike, so it's just a lot of noise. This is probably looks like could be a closing trade at this point, even though vol slightly up on this strike for the day. Mark, if you had to guess right now on this trade, would you guess this is an opening sale or just someone closing out a long position?
I'm going to guess closing out a long as well. That would be the angle I would take.
That seems to make the most sense. So there you go, listeners. All you guys writing in saying, hey, how about some more unusual activity out in VIX? There certainly is a lot of it. We also saw an interesting trade yesterday. Mark, you kind of like this as well. Don't see too many of these, so this is worth highlighting in and of itself as well. It was actually a May 18 AUG 20 straddle swap.
Oh.
Paper coming in and selling the AUG, buying the May. Looks like about 5,000 to 6,000 times. It went up for a net of about $1.65. So looks like they're rolling their short vol position up and out to the AUG expiration cycle. That's about as far out as you can go right now.
Yeah, I mean those roll trades are always interesting. It's it's, I love these guys are actually kind of trying the market. I mean, you'll have people just dumping the near term. VIX flow almost trades like the whole world is constantly long a calendar spread, and which is interesting because, the one piece about VIX is that a calendar spread in VIX is actually short near term, long term, actually gives you less vol protection than an actual calendar spread in like S&P, just because that front month can move so much faster than the back month. So it's certainly interesting.
Yeah, VIX Gamma is almost a different beast.
It really is.
Than the rest of the Gamma.
It's its own thing.
That might be a worthwhile topic for a show, VIX Gamma. How it can come back to bite you. But you're right, it does seem like everyone's kind of along that time spread, and it can be a very, very dangerous thing. And it's funny, I remember when I was out in the S, we'd see these stupid straddle swaps quoted all day long. People just wanted levels. You very rarely see them actually trade. Here's one that actually went up. That's worthy of note in and of itself. We're also seeing some about 4,000 of the March 16, 18s going up today. That's probably just closing. A lot of March activity is closing. Again, just so much noise out in VIX. It's kind of hard to sort it all out. But still, interesting stuff going up. And if you look at all the numbers, yet again, even on a relatively quiet day, VIX just leading the charge across the board from an options perspective. Of course, this is also an interesting week for a couple of reasons. We had non-farms coming out this morning. This is also the first week that we had a non-farms coming out where we actually had a short-term vol product listed. So a lot of people were paying a lot of attention to that. In terms of general options interest in volume and volatility, it seems like there wasn't as much going into this non-farms as there has been in past. The flows weren't that high. Looking at SPY straddles they're factoring about 0.75% move in the underlying, where the average has been in last non-farms nearly a percentage point, about 0.9 points. So people factoring in less of an aggressive move to begin with because of weather and other things. But it's interesting that we actually had VXST listed this week. So, Mark, what was your take on how VXST actually performed through its first non-farms?
It did what you'd expect. It was really expensive. Then it's actually, if the VIX itself is kind of tough, VXST they're obliterating it. They hate it. They're out to get it today. So it's definitely not. It's doing what we'd expect it to do, which is good. And if that's the case, then the CBOE should be happy.
It's like a weekly where the earnings comes out on Friday morning. There's not much left to do.
Yep.
Wither and die pretty quickly and pretty horribly if all else goes as planned. Did that surprise you this week, Mark, that there was kind of a bit of a shrug from the market collectively going into non-farms? There wasn't a lot of premium getting bid up going into it. They weren't bidding up that straddle in the S&P very aggressively. Not a lot of volume going into it. Not a big move coming out of it. Did that really surprise you at all? Or was that kind of what you expected?
I feel like right now, some of the, we're still a scenario where non-farms are not as important. As long as the Fed is in kind of as non-farms doing anything to rock the boat, then, there's not really much of a reason to really worry about it. Now, one thing I'd point out, people are like, well, where's all this volatility coming from today? And I'll tell you where it's coming from, and it is related to treasuries. Because the treasury market, the straddle in the options, was predicting that the yield was going to move like 4 basis points. So 0.04%. And instead the yield moved more than that, like 6 or almost double, I think. And so, you've got bonds now starting to maybe push around the S&P a little bit. The other piece that's really interesting is the action in the VIX Futures today. So yesterday, think about this, Mark. All right, so yesterday, the VIX Futures closed 1505, and the VIX Cash closed 1420. So call it an 85-point spread. Today, you've got the VIX Cash right around unchanged, 1415, and you have the future up 35 cents. How in the world does that happen?
Someone perhaps is bidding in a little extra juice there, but you're right. All things being equal, that shouldn't be expanding at this point in the cycle. That should indeed be aggressively tightening.
I'll be interested to see if the market knows something that we don't know.
I'm glad you mentioned the VIX futures, though, because It is that time of the month where we look back on the month that was and see what was going on from a vol perspective. And if there was a narrative, is that it was a good month to be in the vol business. In particular, looking at the VIX Futures numbers coming out of the CFE, they had an ADV in February of about 217,000 contracts. That's a 35% increase from Feb of last year. It shows you how quiet last February was, and also 3% increase from January. That also shows you how much of a rockin' month January was, only a 3% increase. ADV, it topped their previous record of 210,000 contracts that was set in June of last year. Overall volume in VIX Futures, about 4.12 million contracts. That also is a 35% increase from Feb. Of course, when you look at it compared to January in a total volume perspective, which is interesting, actually it was down 6% from January. Remember, though, February is a bit of a shorter month, so keep that in mind. We also saw the options lighting up the tape as well. VIX options, they set a monthly ADV record of 857,000 contracts last month, which is just craziness. It's interesting, too. A lot of people are picking up on, they've talked about it before, obviously, but now given these VIX numbers, people are starting to hit on it again. I think, in fact, it was written up just in Barron's this week again, looking at CBOE, the stock, as a bit of a vol proxy, kind of like comparing the oil services as opposed to buying the oil futures outright. A lot of people coming out saying, oh, vol is spiking. If you think vol is going to be spiking again in the near term, forget about trading VIX itself. Write some puts out there in the CBOE. Interesting way to play vol. A bit indirect for my tastes, but hey, I've never been an oil services versus oil kind of guy. What's your take on that kind of trade, Senor Sebastian?
I don't know. I've never been a huge proponent of that approach to things. I'm sure that it's fine, but I don't know. It seems a little far-fetched in my opinion that's the best way to play it. And I'm sure that they've got a great thesis as to why they're going to do it, but I'm not sure I'm a huge believer in that approach. It did work, but that should be kind of priced in at this point.
Yeah, you'd think. I mean, this CBOE has had a hell of a run. It's trading today $57.40. It was trading around the 30 handle not too long ago. This thing's had a bit of an aggressive run. I remember thinking 30 handle was pretty top heavy for that name. So seeing it pushing 60 now, you'd have to wager that. A lot of that is baked in. But hey, if you like the downside, writing a put, better, I guess, than coming in and loading up on the stock or just buying a bunch of upside calls like right. Everyone else seems to want to do. And then speaking of just retail flocking into things, you may remember our buddy Chris Cole was on the show recently, Mark, and he went on in depth about his Showshine Boys thesis and how he kind of equates those guys to being the kind of low-hanging fruit retail customers that tend to flock into a product when it gets popular. And he kind of equated them to what's going on out there in VIX these days, with so many people flocking into VIX and then indeed into the ETFs like VXX and XIV. And he has expanded upon that and expounded upon it. He was talking to the Financial Times recently, took what he started here on our show and ran with it. He started talking about his Showshine Boy trade again and kind of comparing it to what the public is doing out there versus what is an actually better strategy. And he kind of broke it down and looking at it on a risk-adjusted, equal volatility weighted basis. The return, if you were consistently shorting volatility on the front part of the curve, which, as we know, is exactly what an ETF like XIV does, because it has to rebalance all the time, so it's constantly shorting that front part of the curve. That return on doing that, or buying and holding XIV, essentially, is significantly lower than if you just went out and just bought the S&P. Since November of 2010, it looks like the annual return in this time frame is about 14.25% for the S&P. This is risk adjusted, and risk adjusted for XIV is 9.16. So if you held the S&P, you could have earned higher return per unit of risk than if you just bought and held this inverse VIX ETP, which has a lot of problems, not to mention all the rebalancing issues we've discussed here on the show in the past, but also big sharp spikes like we saw earlier on Monday, and things tend to really dramatically negatively affect things like XIV. Chris went on in this article to elaborate again on the Showshine Boys that are out there shorting this vol, and kind of mentioning also that just in general, something we talked about on the show as well, about how another reason you may not want to do that is because just the the volatility, particularly in the VIX Futures, gets extremely heavy, vol, I should say, in the last 10 or 15 minutes in the closing period of the day when all of these crazy products are coming in and rebalancing. And that also tends to disadvantage a lot of these retail, aka showshine boy type customers. Mark, I know this is probably music to your ears because you've been, let's say, not a big proponent of XIV for a while. Here's more dramatic evidence that people coming in and buying and holding that product like that, it really is not the right course of action.
No, I agree with you 100%. And there's so much smarter ways to do it and smarter ways to get into it. And yeah, maybe it is the showshine boy trade. And, I think a lot of people got wiped out by the showshine boy trade, shorting TVIX or long XIV or whatever on that last move up. I think it taught people a lot of lessons. It was interesting. I actually met somebody, and in that whole process, they knew what contango was, but didn't know what backwardation was.
Kind of two sides of the same coin there.
No, like legitimately, the guy was like, well, I make money because it's contango. I said, well, what if it goes into backwardation? He goes, well, what's that?
How do you learn one without learning the other? I don't understand.
I didn't know either, but apparently you can do it. And I told the guy, I was like, you should not be doing this trade. And it's just dangerous. I think this is not a product that's meant for your average retail public. You need to be a pro to trade and manage it. And risk adjusted, XIV itself is a huge underperformer, even to just being short the regular VXX. And I would tend to agree with him that since 2010, especially with that 30% rally we had last year, I wonder if you cut that rally in half, what the S&P looks like, what our 2010 risk adjusted looks like.
Yeah, you're always wondering about these frame of references that they pick.
Yeah, no, it's an outlier period of time, but it really is. But I'll tell you, being short for like all of 13 was a great trade.
I like your analogy to the guy doing the contango but not backwardation. That's like saying I bet on coin flips, but I only understand heads.
No, I mean seriously.
You ask him what's tails? He says, what is tails? I don't know what that is.
What's tails?
I am completely ignorant of half of the outcomes on this.
Exactly.
That's fantastic.
Or like he bets on the over under. What's the under?
Yeah. What is under? I didn't know that could happen.
What's red?
I can understand 00 maybe, but red or black. Yeah, but that's crazy.
I get black, but what is red? Someone told me I should always bet on black, so that's all I ever learned.
Yes, we are the Snipes cast here. Before we close out here, Chris also closed out the article, kind of touching on something that we've touched on a little bit on the show in the past, a lot actually, but taking it a little bit different direction. In fact, he and I discussed when he was on the show about this notion of whether all these VIX ETPs are starting to wag the dog in the main product. He kind of coined it a different way, which I think is kind of interesting here in this article. He wrote that now he wanted to know if the VIX futures are actually starting to push around the S&P 500. That was kind of his thesis closing out the piece, because they're becoming more popular than some of the classic hedging or classic option strategies.
I not for a second will I buy that. Maybe on a really slow day in some intraday, but when you take the market of the S&P and SPY and the upstairs desk and all that stuff, no way. Not for a second will I buy that. Just not going to happen.
I'm thinking of it more in terms of like a volatility impact. I'm not sure if he means as a straight up underlying, in which if that's the case.
I mean, maybe.
If that's the case, then I kind of agree with you. I don't think it's moving the S&P. But I kind of thought he meant more as
like driving the VIX. No, I mean, look at the amount of option volume in the SPX. These huge trades in VIX, in order to get anywhere near the notional value of an S&P trade, you need to divide that number by like 12. And then that doesn't even include SPY that's doing massive volume today. So all right, so let's look at, so VIX Futures are doing 180, they're going to do, probably, 186,000 contracts, and times 1,000, you're doing 186 million Vega in a day. The SPX does a million, the SPX does about 1 million contracts a day. So, and those are $100 multiplier. So, yeah, they're in the ballpark, I guess, right?
And they're not as far off as they would have been.
They're not as far off as they would have been. Now, that doesn't include SPY or S&P futures or anything like that. But I'll
have to reach out to Chris and clarify exactly what he's talking about here. Because if it's underlying, it's a little bit harder to wrap my head around. But if he means like maybe way some of these traditional hedging strategies are performing and the vol there and some of these products, I could certainly buy that.
I could be talked into that to some degree.
To some degree. There we go. All right. With Mr. Sebastian begrudgingly admitting some acceptance, we're going to keep on rolling into actually my favorite part of the show. We don't get to it as often as I would like because we've had so many great guests. Not a bad problem. But it's time for you guys to take your moment here on the old Volatility Views panel because it's time for the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options. or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility voicemail segment. As the man said, a lot of great ways for you guys to get in touch with us, not just the titular voicemail line, but Twitter, Facebook, email, all that fun stuff. And first up, we have a question from Mr. Bryan Tong. We're getting a lot of different variations on this same theme here. I surfaced up Mr. Tong's question here, so he gets pride of place this week. He writes, when will we get VXST options? Soon?
And the answer is yes. Yeah, we're getting them very soon. The CBOE has every intent to put those up as soon as possible. The underlying needs to trade for a little bit before they can list futures or options. That's just a general rule. I think the minimum is like 13 days, but I think they'll probably, because this is a more complex trade, I think they're going to be listed probably very early Q2.
You know, the plan, at least initially, was, and in fact, CBOE holds a big luncheon here in Chicago every year where they kind of inform a number of outlets here about their plans for the year. And at the time, they were talking about the VXST, and they had the futures approval date, obviously. And the plan, even then, I remember I outlined it here in my notes, was that options, quote, a few weeks later. So we're getting into the few weeks period, but probably it does take a little while for all that stuff to shake out. But yeah, soon, I think, is a good characterization of it, Mr. Tong there. You should hopefully be getting them soon. Given all the interest they have in pushing this product out, they're not going to delay it any longer than they have to. All right, next up, and Mark, this question is great. I can't believe we've actually never received this question before. It makes so much sense, I think, for a certain aspect of our listenership here. I'm amazed this is the first time we got it, so I had to surface it on the show here. This is a question from a listener, goes by the handle Enten. He writes, if I buy SPX and write VIX calls against it, is it technically a covered call? Will my broker recognize it as a covered position? And I think this is a fantastic question, just because I'm amazed it's never come in before. And it makes a certain sense from a certain amount of logic. Sister Sebastian, would you like to take this one, or shall I?
Well, you start, I'll finish.
There's a lot that goes into this. I could see, Mr. Enten, how you could maybe on the surface see that, because you think, hey, you're buying, let's say, an SPX option or something like that. You're getting long some implied vol of the S&P. What is VIX but the implied volatility of the S&P? So technically, if you wrote that call, it should be able to be called away, at least theoretically, and you could surrender that. The problem is, it's not really how the products work. A, they're both cash settled. B, you can't pull your Vega units out of your SPX contract or even your SPY and then transition them in some sort of fungible form into some sort of VIX deliverable. That's an interesting idea. I think it would be kind of cool if you could do that. But unfortunately, just the mechanics of it just aren't there for it to actually happen.
Yeah, and the other issue that you have is that you've got one that is a pure play on Vega and one that has a bunch of gamma to it. And, having been in trades where the S&P falls and vol doesn't increase, and more likely the S&P rallies and VIX rallies at the same time, you're going to have all kinds of problems with trying to convince your brokerage firm that you're not slapping on additional risk with that swap trade. I'm not saying that it's not a smart trade. I'm just saying that there's no way you'll ever get cross margin.
Yeah, I want to be on that brokerage call when you call up your broker and say, hey, I'm covered.
And just hearing them laugh.
I've got these short VIX calls. But, it kind of brings up an interesting theoretical idea. What if you could do that? Someone could come up with some sort of widely available contract that people could actually break out the Greek components of their contract and kind of hedge them off in different ways. Obviously, we used to trade on the floor delta neutral. That got you to a pure vol perspective. You can, of course, do dispersion trading to trade and hedge and spread out your vol. But it'd be interesting if there was an actual product designed around that where you could say, here's this product, and it can be broken up into its core components, and you could hedge these off individually. Obviously, you can do that on an institutional level, but for, let's say, a VXX or a VIX options retail guy, a little bit more difficult. It'd be kind of interesting theoretically to see someone try to tackle that. A great question, Mr. Enten. I'm amazed we haven't received it. Short answer, no. Unfortunately, you can't do that.
Will never happen.
Yes. All right. Next up, in honor of St. Patty's Day, we have an Irishman on the show. This might be our first Irishman, Mark. I'll have to see. And he writes, this is from Mr. Declan Smith coming out of Dublin, and he writes, why do so many people buy VIX calls to hedge their long premium SPX or SPY positions? Don't they know that they are already long the implied volatility of the S&P, also known as the VIX? If anything, they should be selling those calls or buying puts. Another great question. Another one I'm surprised. A lot of people writing in about VIX call writing today, which is interesting. And you're right, people, that kind of gets a little bit back to what Mark was saying earlier about the guy trying to trade contango and not understanding backwardation. People are coming in and buying these SPY contracts or these SPX contracts, probably more the former than the latter. There are a lot of retail more diving into SPY than SPX these days. But they're buying these positions, and like we said on the show many times, particularly from a retail perspective, they tend to view these things directionally and not as a volatility play. But you're right. Theoretically, they are long implied volatility. If they want to hedge, buying a VIX call is not the ideal way to do that. But what they're thinking of it is purely from a directional perspective. They're buying a VIX call because they want the underlying index to rally, at least in their heads, that's how they're thinking of it. And they're thinking of their main risk being to the downside directionally, again, not from a vol perspective. And so they think if we move downside in the index, the VIX is going to pop. Therefore, I am hedging myself directionally by buying this VIX call. On that mindset, which is the delta-focused mindset that a lot of retail tend to trade around, it makes a certain amount of sense. But you're right, when you're looking at it from a pure actual vol perspective, it's not the ideal trade for you, and that's why a lot of pros aren't in there doing it on a regular basis.
I don't correct perfection, and that was the right answer that you just gave.
I do have my moments, sir. Next up, we have a question from Mr. Tim J. And he writes a very, very simple question, actually, but a bit of a longer answer. What is the settlement process for VXST? Tim, if you listen to the show we did maybe about a month ago or so, we had Jay Cowie from the CFE on. We kind of went into that in a lot of detail there. But, long story short, it's essentially the same process as the big quote-unquote VIX. It's just on a different schedule. It's on that weekly type schedule. In fact, I'm pulling here from the CBOE website, verbatim. It says the final settlement date for a VXST futures contract is on the Wednesday of the week of the month denoted in the ticker symbol of that contract. If it's on a Wednesday or a holiday, then it changes a little bit. But other than that, it's essentially what you're used to. It's just on a more frequent basis.
Well, it's not really trading that much yet, so we'll talk about it some more. But no, I mean it's the volume in the weeklies is as such that is one that could get more easily jerked around. One might think theoretically, but so far so good.
All right, that's all the time we have for the volatility voicemail for this week, and now we're going to roll right on into our final segment, the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball segment. This is, of course, the portion of the program where we peer deep into the future and attempt to figure out what the vol gods are holding in store for us. over the coming week. Mark, there's a lot of different ways we can carve this up. We can look at VIX, we can look down into VXST, we can go further afield into commodities. Where would you like to start in this week's Crystal Ball segment?
I think that where the vol is going to be interesting is in the treasuries, where they're moving. And then the question is, they're continuing this path of not letting weekend vol come out. So I'll be interested to see. I think Monday you're going to see another vol. If there's nothing from Ukraine, it will be a vol bloodbath. They're doing a good job of holding up vol today despite almost no movement out of the S&Ps. Now, if we get something out of the Ukraine, that'll be a different story. But until something like that happens, vol, they really do not want to let you be short gamma right now. And the main reason is that it's been short gamma has been a tough trade. So my crystal ball is something's got to give. We will not be plus or minus 2 ticks of 14 for 4 days all next week. Something will happen, and it'll either be Ukraine or it won't be Ukraine, and then you'll see vol really get smoked.
Yeah, and you're right. Like I said, as we're recording this, vol ticking up a little bit again. People may be a little bit leery after last week, getting caught a little flat-footed over with the literal weekend risk, not wanting to repeat that trade in case who knows what happens over there in the Ukraine over the weekend. So keeping a little bit of some firmness to vol. We'll see if that holds for the rest of this week. I think the vol play of the last week or two is definitely also, in addition to what you said in the treasuries, has been out in nat gas. Things have been moving like crazy. Again, also driven many markets moving on the heels of this Ukraine thing, and nat gas has obviously a big area for natural gas usage and deployment. So that's moving the markets. I believe was up 2% again just the last session. So a lot of aggressive moves. A lot of people have been caught short in the past out there, starting to flip that script. If you were long vol out in nat gas, you were looking all right. I think if I had to bet anywhere where there would be continued volatility over the coming week, I might have to put my chips down in the nat gas realm. It seems to be coming off a little bit now because we had a kind of a similar play out where it spiked initially, then it kind of came off a little bit, but it still is moving pretty aggressively. Certainly more than what we're seeing in the major index vol, which is something to keep an eye on. I know a lot of you guys, again, writing in want more commodity vol. So there you go. There's your little bit of commodity tip. But if this keeps up in nat gas and other areas, we could do a whole commodity vol show. It's getting that crazy out there. So certainly something to keep an eye on for future episodes. Unfortunately, that's all the time we have for this episode of Volatility Views. But before we go, let me thank my cohort here, my partner in crime, one Mr. Mark Sebastian from OptionPit.com and from Swan Wealth Advisors. Mark, what is cooking out there in the land of Swan and the Pit?
Swan Re is kicking. We are all about reinsurance. And at Option Pit, we should have a couple of things rolling out in the next week or so that people will find interesting. So just, check out the site on a daily basis. You'll like what you see.
When I first met you, I looked at you and said, that's a reinsurance man if I ever saw it.
Thank you.
I can see you knocking on my door, selling me some reinsurance. It's good stuff.
That's what I'm famous for.
All right. And, of course, I also want to thank all of you guys out there in the listening audience for downloading and streaming and subscribing to this show and for sending in such great questions. Keep them coming, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.